Welcome to Live Better Longer. I'm your host, Bill Borton. Every Tuesday at 11 on RVN TV, I'll be hosting Live Better Longer, where you'll be experiencing experts in their field who will be providing you with actionable information and great counsel on ways that you can live better longer. Today, my guest is Scott Inglis, Portfolio Manager with Carnegie Investment Counsel. In addition to heading up Carnegie's Philadelphia office, Scott also happens to be my financial advisor. Welcome, Scott.
Thank you, Bill. It's an honor and privilege to be here on the inaugural Live Better Longer. Thank you for having me.
Wonderful. Well, thanks for joining me, Scott. Please tell our audience a little bit about what you and Carnegie do.
Well, Carnegie Investment Counsel is a registered investment advisory firm, Bill, and we build custom portfolios for our clients, and we provide strategic financial advice. And by custom portfolios, what I mean is, as opposed to the one-size-fits-all type of investment management, which seems to be growing in prominence, we believe in personalization and customization. And secondly, when I talk about strategic financial advice for your folks, really we try to work with our clients and meet them where their real lives and their financial lives intersect, and provide them with important strategic advice for those big important decisions, such as, do I have enough money to retire? Can I retire now? How do I fund my health care in retirement? Mm-hmm. Those types of things that are front and center in people's lives, whether it's college planning or retirement planning, we provide them with the strategic financial advice to make the right decisions.
Mm-hmm. That's great. So I know a number of people these days seem to think that because of the internet and passive investment firms like Vanguard that they can do it themselves. So, but why is having an advisor so important, in your opinion?
Well, I think there's some compelling evidence that suggests that having an advisor is not only important but can be essential these days. In fact, Morningstar and Vanguard have both recently published studies of the value that a financial advisor can bring to a client relationship, and they've quantified it.
Really?
They have. Vanguard's piece is more recent and suggests that as much as 3% per annum in value can be added to client portfolios from working effectively with their financial advisor.
3%?
3%.
And that's from Vanguard?
That is a Vanguard study, correct. And
Mm-hmm.
It's relatively recent. What they highlight really three things, Bill, as being the most important aspects where the financial advisor can add value: behavioral coaching,
Mm-hmm.
cost control, and rebalancing. But behavioral coaching essentially means the advisor providing the emotional distance and objectivity to the client relationship so that they make better decisions with their portfolios. Mm-hmm. That behavioral coaching accounts for about 1.5%. It's a staggering amount of the 3% in value add that Vanguard suggests that an advisory relationship can bring, Bill. And it adds up to significant dollars for living better longer. Mm-hmm. It can add years in portfolio income for prospective clients. Quantifying it further, $1 million portfolio over 10 years between Morningstar and Vanguard's estimates, you'd be talking about $150,000 to $300,000 in additional retirement assets
that
accumulated.
Much?
If you quantify it, yes.
Wow.
$30,000 a year over 10 years, and that's not even considering the compounding benefits that might come from reinvesting that benefit.
Well, you know that I'm a big believer in having professional advice, because back during the dot-com era, I was one of those guys that could turn dollars into dimes with the best of us. And I learned a lesson at that point in time, and so that was the last time I decided I'd be a do-it-yourselfer.
Well, buy low, sell high is easier said than done.
True, especially if you're emotionally involved.
True. The closer you are emotionally, obviously, to the financial decision making, the easier it is for your emotions to get the best of you.
So Scott, if you're going to consider hiring a financial advisor, what would you suggest are some of the main points that you need to know about? And I want to hold up this brochure.
Right.
Tell us about this.
Well, that's Gary's Guide to Hiring a Financial Advisor. Gary Wagner, our Chief Operating Officer, put that piece together just precisely because there's so much confusion out there and so many choices for people to make when they hear the word financial advisor and don't know necessarily what it means or what they should look for.
There are a lot of people out there that call themselves advisors or wealth managers that
Sure.
really aren't.
Sure, there's a whole spectrum, but the 4 points that Gary covers in that hiring a financial advisor piece that might be useful to your audience, really the first is fiduciary standard versus suitability standard. The other 2 points he addresses really are around cost, understanding the total cost of the investment program,
Right.
and understanding how your advisor is compensated.
Okay.
And then the last point that's made in there, it really covers the security of client assets, which
So by
is
that you mean what? The custody, where the assets are
where the
actually
assets
kept?
are held and how they're held is an
Okay.
important component. So those 4 things are covered in the guide. And if you'd like, we can flesh those out a little bit more for your viewers.
Sure. Well, if any of the viewers are interested in Gary's guide, they can get that at carnegieinvest.com, right?
Sure. Yeah, they can access that and we have other resources available for prospective investors and people who are looking to educate themselves on hiring an advisor, and our firm available on the website. And I encourage people to get it. I think it's really well done and helps people understand some of those key elements of the decision.
So fiduciary is really becoming part of the lexicon.
It is.
Particularly over the last year or two with the DOL fiduciary rule. So tell us a little bit more about what a fiduciary is, or who a fiduciary is, and why that's important.
Well, it's extremely important, and it should be extremely important to every investor out there, because the fiduciary standard requires that an advisor always act in the client's best interest ahead of their own, and disclose any conflicts of interest that might arise in the relationship between the client and the advisor with complete transparency.
So a conflict of interest might be something like receiving third-party compensation from someone to recommend their fund or something like that?
Sure, there's many, in the financial services industry, as you can imagine, where there's so many financial products that are sold to clients, there are often hidden fees and charges and things that clients just simply aren't aware of, but need to be made aware of. And the fiduciary standard attempts to raise that level up, that level of disclosure up. And so if someone is considering hiring a financial advisor, Bill, one of the very first questions they should ask anybody is, are you a fiduciary? Are you required to uphold the fiduciary standard?
Thank you, Scott. We're going to take a brief break for a word from our sponsors. We'll be right back with Scott Inglis from Carnegie Investment Advisors on Live Better Longer. Welcome back to Live Better Longer. I'm your host, Bill Borton. I'm here today with Scott Inglis from Carnegie Investment Counsel. Before our break, Scott and I were discussing the important things you need to know when hiring a financial advisor, and we just finished talking about the importance of a fiduciary. Scott, you mentioned there were 3 other key points. Would you please elaborate further?
Sure, Bill. Yeah, I think the other 2, after fiduciary, are really focused on cost.
Okay.
And educating oneself about the overall total cost of the investment program is essential.
So when you talk about the cost of the program, you're talking about the investment fees and your fees?
Sure. A lot of times there will be an advisory fee, but the fees around the investment program itself are sometimes misunderstood or not as well understood as they should be, and they can add up to as much as a total cost can add up to as much as 2 or 3% I've seen.
Wow.
In a lot of cases, which is just as much as we were talking about the benefits that an advisor can bring. Those types of costs can take years of retirement income away from
That could be a game changer
portfolio.
for somebody in later years.
It can be. So total costs would be the expenses and expense ratios on any funds, any commissions for products that have been sold, tax consequences, and the internal costs of management, trading costs, buying and selling, and commissions. All these things can add up to be a lot more than meets the eye on the surface for prospective clients. So they should really work to understand what the total cost of management is, not just the headline.
So when you work with Carnegie, give me an example without going into great detail, but what kinds of fees would somebody expect to pay?
Well, we have relationships with a number of different broker-dealer firms. We're independent, so their commissions are going to depend on who we're working with, but it might be $5 a trade, for example. Whereas a full commission firm might charge well over $100 per trade. that's a massive difference, and it can add up over time. When you're doing 20 trades a year, 20 times 100 is obviously 2,000. So that's that's a lot of money, and 20 times 5 is only 100. That's a huge difference in cost. So that can be a hidden example. But Carnegie does a lot of direct investment, Bill, when possible. We use individual securities, and so we don't incur additional layers of fees for clients, which come from mutual fund expense ratios, possibly even front-end loads, or exchange-traded funds also have expense ratios. So when we can, we try to strip those costs away from the investment program so that clients are getting as low a cost investment solution as possible.
Okay, so what else is important?
Well, I think similar to the fiduciary rule versus the suitability standard, Bill, the advisor, how the advisor is paid is essential to understand for anybody looking to work with an advisor. What you're looking for is alignment of interests here, where if I'm paying someone for a service, I want to know how much they're paid, and I want to know how what they're paid, and I want that compensation to be aligned as possible with my interests as a consumer. So, for example, our fees are primarily based on a percentage of assets under management.
Is that fairly typical?
It's probably the most common and conventional standard for registered investment advisory firms such as ours. And in that arrangement, the client we're fee only. In that arrangement, the client knows exactly what they're paying based on the assets that they've asked us to manage. And as their assets grow, our fees grow in line with their assets. But if their assets were to decline, our fees would go down as well. So there's alignment there between the client's interests and our interests and how we're compensated.
So you mentioned fee only, Scott. That brings up a good point. A lot of advisors say we're fee based.
Correct.
And they say that in a way that's meant to imply that they're fee only as well.
Correct.
But there's a big difference between fee based and fee only, isn't there?
Huge difference, and mainly it comes to financial product sales. Someone who's fee only does not engage in product sales. So fee based means that you can sell securities and earn a commission. It might be insurance products, it might be security products.
And that would be in addition to
fee
for assets under management.
Correct. And those that can lead to a bit of a misalignment of interest between the client and the advisor. And so it's something, again, that everybody who's looking to engage with an advisor should be asking, how are you compensated? Are you fee only? Preferably fee only, and preferably understand transparently what those fees are.
So stepping back for a moment, the other type of an advisor besides a investment advisor with a registered investment advisory firm would be what's called a registered representative with a broker-dealer.
Right, typically of a larger financial services company. It might be an insurance company or a brokerage firm that also sells financial products.
Gotcha. So some of the big logos, the Wall Street logos, would be examples of people who are registered representatives and would be fee-based rather than fee-only.
Correct.
Okay, great. So you mentioned one more thing, and that's about security and safety of your assets.
Right. So custody and where assets are held is very important for people to understand. And an independent custodian is strongly recommended as a safeguard and a firewall between the investor's assets and their advisor. For example, there are many independent custodians. A number of the ones that we work with would be recognizable to many of your viewers.
Like Charles Schwab or
Schwab,
TD Ameritrade.
Fidelity, TD Ameritrade,
Okay.
Correct. Where working with an independent advisor, the assets are held securely at a custodian that's independent of the firm with which that is providing you the advice.
Great.
So there's a firewall there.
Thank you, Scott. We're going to take another break for another word from our sponsors, and we'll be back in another moment with Scott Inglis from Carnegie Investment Counsel. I'm Bill Borton, your host. Welcome back to Live Better Longer. So, Scott, tell us about, when planning for retirement, what are some of the successful things that people, what are some of the financial keys that people need to pay attention to become successful in their retirement plan?
Sure. Well, Bill, working with many different client relationships, we do see certain patterns of success. And, typically, I'd say there are three areas that if people really focus in on, they're going to put themselves in an excellent position to live better longer, to have the financial resources to live better longer. Number one, when you have a retirement date in mind, you should be focused on arriving there with as little or no debt as possible when you get there.
So student debt you co-signed for, mortgages, things.
Sure. I mean, let's say you're in your 50s, between 50 and 60, and you're trying to move towards that retirement starting line. You should really start focusing in on what are your outstanding debts and what can you do to reduce or eliminate them prior to your retirement date.
That means you need less income in retirement to service the debt.
It gives you more flexibility in retirement as well.
So what else?
Well, the second thing I would suggest is to put yourself in a position to what I call avoid the room, the acronym ROOM, R-O-O-M, which is people's biggest fear, which is to run out of money.
Okay.
So there are various tools that can be used to avoid running out of money, but the single biggest one is to know exactly how much you expect to spend in retirement. And then to make sure that you are not putting too much pressure on your retirement resources, your portfolio, by over withdrawing, having a high need to withdraw money from a nest egg in order to meet your spending. A sustainable withdrawal rate, I come from a pension management background where we're investing for distribution, which is a big transition in retirement. So retirees should start to focus in on a 4 or 5% level of withdrawal at most from, in the initial years particularly, from whatever their nest egg is in retirement.
So really that means if they have $1 million, they're looking at a $40,000 to $50,000 before tax income.
Correct. Using those numbers, but to the extent that they might currently need $80,000 and push up towards closer to an 8%, 9%, 10% withdrawal rate, we really counsel people to strongly put themselves in a position to avoid that, because that takes years of retirement income away down the line. It shortens the runway in retirement.
Well, of
so
course,
that's the second thing.
everybody's going to have some Social Security at some point. Of course, the
Sure.
longer you wait, the more you'll receive.
Sure.
And then, of course, some people, although very few these days, are fortunate enough to have pensions, such as my wife and I.
Right.
So,
So those various income sources are very valuable, and especially the ability to put off when you're withdrawing, when you're drawing on your Social Security bill until 70 at latest. But the only way you can position yourself to do that is by positioning yourself to have a low withdrawal rate early in retirement, and a low pressure, low need to withdraw from your nest egg. So that's the thing. And then the third thing, Bill, is what we call the retirement red zone, plus or minus 5 years around your retirement date. So let's say that's age 65, age 60 to 70. Those are really critical, crucial years for people to navigate successfully. The ones who do navigate that period successfully, they make adjustments to their portfolios. They're very cognizant of their spending needs, especially early in retirement. So they might get more conservative both in their lifestyle choices as well as in their portfolio allocation while they're navigating that time. Because it's very vulnerable, and timing is essential. And so we want to take as much timing risk off the table. And by timing risk, what I mean is no one knows exactly what the markets are going to do during that window of time when we retire. Worst case scenario, obviously, is somebody retires between 2007 and 2010, right in the middle of a financial crisis. We can never know exactly when that type of environment or a recession might present itself again, but avoiding an aggressive portfolio allocation or excess spending and putting yourself in the position to being a forced seller in that red zone window is essential to success. Really set yourself up for success by navigating that well.
Another way that people can help to reduce the potential impact of what you refer to as sequence of returns risk is through the use of home equity through a HECM or reverse mortgage, which is a subject for another day.
That's right.
Absolutely.
There's a lot of tools for managing that successfully, but engaging with an advisor who's sitting on the same side of the table as you are and helping you through it, we find is very
with all your years in the business, Scott, working with so many different clients, what are some of the major pitfalls that you've seen?
Well, there are many pitfalls, but retirement distribution choices and making mistakes on retirement distribution choices are some.
You mean like from 401ks and IRAs?
Or choice of when to take Social Security and how to take Social Security, but certainly distributions from 401ks and pensions where there's lump sum or annuitization and survivor benefits to decide amongst. But even as simple as how to have the distribution from a 401k made and properly made into a rollover IRA is a pitfall I've seen recently where if you have the distribution check made out incorrectly, for example in your name instead of the custodian's name, there will be taxes withheld and tax consequences, and if you don't properly roll over the money into the IRA within a time window, you will lose significant taxes and tax advantages that were there for the.
So are there any other significant pitfalls, Scott, that you could think of?
Well, we talked about overspending and not knowing yourself, in monitoring your needs in retirement, not planning ahead for healthcare costs. There are a number of things that need to be successfully navigated, but those are probably the largest pitfalls I can think of while in retirement or in that red zone. Obviously, if you're in your 50s or 60s, Bill, the biggest issue that people face is undersaving. Undersaving, underinvesting, underpreparing. In fact, I saw a Federal Reserve study from last year, from 2016, that suggests that the average American between 50 and 60 has only saved $125,000 for retirement.
That's shocking.
Well, for some people it might seem like a lot of money, but in a 5% withdrawal scenario, that's only $5,000 or $6,000 a year in retirement income that you can sustainably pull from that. It's just not enough for most people. The median, which is different than the average, the median means half lower and half higher. The median between 50 and 60 has saved less than $20,000 towards their retirement.
That's ridiculous. It's amazing.
So, the biggest pitfall for somebody in their 50s and 60s is not saving enough, not getting aggressive enough in their saving and investing, and taking as much control of the situation as they can during that window of time prior to retirement.
So Scott, in the remaining minutes that we have, tell us a little bit about what you see going forward. Get your crystal ball out. I mean, we're coming up on the latter stages of the longest bull market, and everybody's made money in the last few years. Where do you see things going?
Well, the environment couldn't have been more friendly for investors the last 8-9 years since the financial crisis, and in particular, this year's been outstanding. But looking ahead, Bill, the fact that returns have been so strong historically means that people should really dampen their expectations for what the returns are going to be going forward. So people who are looking to live better longer and from their retirement resources really need to figure out how to do that in a low return world.
So both on fixed income, where they might see, 1 or 2%?
Low single-digit returns from fixed income for sure.
And with equities, 5, 6% maybe?
I think 5 or 6% would be, over the next 10 years, would be a good outcome.
Right.
Would be a good outcome. Below average, but would be a good outcome. But that means that if you're drawing 10% from a portfolio and only earning a blended return of 4 or 5%, there's a mismatch there.
And you might run out of money. Well, Scott, thank you so much for being on the show. It's been great having you. And for those of you who might be interested in contacting Scott, you can reach him by email at sing, S-I-N-G-L-I-S, at carnegieinvest.com. Scott Inglis is sing-lis at carnegieinvest.com, or you can reach him at 484-841-1252. That's your direct dial phone number, right, Scott?
It is. Thanks, Bill. And
All right.
Congratulations on your show, Living Better Longer. Wishing you much success.
Thank you, Scott. Thanks for being my first guest. Thank you, and we look forward to seeing you again next Tuesday at 11 on RVN TV for another installment of Live Better Longer. I'm your host, Bill Borton. Have a good day.